Good morning, ladies and gentlemen. As always, we start with the American fixed income market. This is the 5-year note. The yield last week fell very slightly after trying the upside to 185. Not much change in our views. We still think we trade this 0.382 retracement at 165, trying to make a marginal new low in an ABC pattern down to correct this move that we had from basically 1% to 210. The data last week showed very little inflation, very little growth. The GDP forecast for the second quarter is going to still be around the 3% mark, but annualized we are looking somewhere below 2%, i.e. Trump has really not done anything to change the slope of the recovery. It is still very, very shallow, and I really don't know how long the market is going to be patient with Trump. That is the thing that really has to worry us. If we at some stage lose patience and we see that these tax cuts are just not going to happen even in the medium term, or some political event takes place that makes the crisis, the political crisis in the States deepen, we think that yields could continue on their downtrend. But certainly for the time being, for the next few months, we are not looking for anything below 165 in the 5-year note. For the 10-year note, again, that's the level 213, the 0.382 retracement, again an ABC correction from this move from about 135 to 260. I know that a lot of people who trade fixed income professionally think that the market will go to 320. We find it very hard to believe unless we start seeing some strong data. The Fed is completely data dependent. We need to start to see some strong acceleration in growth and or inflation, and for the market to start thinking that the Fed is going to be behind the yield curve. That is, at the moment, is just not happening, and therefore we see no reason to change our minds and think that we are still in a correction phase over the next several weeks down towards this 213 level. The 30-year note makes us even more convinced that we are right. As you can see, we have lost all impetus on the upside. We are now correcting, and we think that quite easily we could stay in this corrective range for a long time. The 30-year note is the one that's 30-year bond rather is the one that's least exposed to short-term moves by the Fed. Until we see that picking up in yield and looking to break higher, we really can't think that we are in anything but a correction phase in the 2s, 5s and 10s in the States. In Europe, we are more or less in the same situation as in the US. We tried the upside last week. This is a daily chart. Let me switch it to a weekly chart. So you can see we touched the Bollinger Band and we came back. This kind of action probably will prompt a test of 0.75 in terms of yield in the 2-year Schatz in Germany and not much else. In the 5-year, again, this is a weekly chart now, we really can't see it much below -40. this is going to be a level that's going to be very tough to break on the downside. And in the 10-year bond, we see this level being somewhere around minus 0.32, i.e. 32 basis points. Again, this shows us that there is very little going on in Germany and in the EU as a whole. Spreads are roughly stable. The market is just consolidating before it has enough fundamental data impetus to break to the upside in terms of yield. We think that break will come, but it's certainly not going to come until much closer to the middle of the summer, when the ECB could start signaling that it'll start reducing the the QE from 60 billion a month to say 30-40 billion a month, and then we could see some moves higher in the German yields. This is the Italian bond, and as you can see, it is now contracting. The range is more or less defined. We will stay here for quite a while before we start breaking higher again. Given that we expect so little from the US fixed income side and also so little from the EU fixed income side, it should not come as a surprise to see the Euro USD just moving sideways for the next few weeks. The 200-day moving average is still pointed down, so we need a bit of time to get that to turn. The 50 is coming up to meet it, and there will be some pressure to the upside in Euro USD. 110.60 is the level that has been a magnet for the past 2 or 3 years in Euro USD. We have no doubt that we will test it over the course of the next several weeks. So our overall bias, but very slight, is for a stronger Euro USD, which just should indicate that there are flows towards Europe, which is not surprising. We have seen some enormous inflows into European equities over the past few weeks, and that should continue into the summer as people anticipate that Draghi will lower the amount of stimulus and say that the economy is doing fine, and therefore equities should outperform fixed income in Europe. So mild uptrend in Euro USD, with 110.60 acting as some sort of a magnet over the next few days and weeks. Putting a chart of the yield of the 5-year note against a chart of DX, the dollar index, actually is like more or less watching the same chart. These moves are now getting compressed. You can see how it took a much bigger move in the 5-year note to provoke any move in the DX, and that just means that this contract is now coiling at this level. It is right on top of the 200-day moving average. It's going to take a lot of time to change the slope of that 200-day moving average. So what we are saying is that the market is going to be, the FX market is going to be in a very tight range for many days before the next move can take place. We think we definitely at some stage test 98, and we think that par 100 is going to be very tough to break on the upside. So 98 to par will trade for quite some time before we are ready to decide which way to move, which gives you basically, if you just watch these two trade in parallel, it'll give you the range in the 5-year note. As I said, 165 to the downside and 98 or just below to the downside in DX. You will remember that several weeks ago we told you that we couldn't see the bonds moving significantly higher in yield without help from the commodities. The commodities have to show that this reflation trade is working, and they are showing absolutely nothing at the moment. They are at the lower level of the range for the past year and a half, and we just don't see the bonds taking the lead all by themselves without some help from the commodities. Basically, these charts are telling us don't look for much higher yields in bonds. It's not going to happen right now. We will keep on watching them because we think they are very important, but as you can see, nothing there, nothing to write home about. Basically, the market is going to remain lethargic in terms of yields for the foreseeable future. As far as equities are concerned, well, what can you say about a market which remains in less than a 1% range for the whole of the week? The only thing that one can say is that it's doing nothing, and that is indicated by the Bollinger Bands, and that is indicated by the moving averages, and basically it's saying that the market doesn't like it above 2,400 and it doesn't like it below 2378 in the INX, which is about 2375 in the ES. Not too profound, is it? Well, rather than looking at the minutiae of the ES, let us have a look at some longer term spreads which might give you a much better indication of what is really going on under the surface of a very, very quiet and churning market. The first chart that I'd like to look at today in terms of what the spreads are telling us is XLP over SPY. So consumer discretionary over the broad market as a whole. Well, we had the panic of '08 when everybody got out of consumer stocks because they thought the consumer was broke and would never spend again. And then we had the risk on trade moving from 2008 to 2011. The interesting thing is that with all the stories about how the consumer is tapped out and the consumer is basically over indebted and the consumer is doing nothing, we are still very, very close to breaking below the post-financial crisis levels. And this is certainly a spread which is very good at predicting risk on and risk off. We are still, this spread says, very much in the risk on phase of the market. So that is very important to bear in mind. This is basically a 6-year range that the market has been in. Very shallow trend, as you can see. If now we start breaking to the downside, that will mean an acceleration in consumer spending, and that is for something that we are looking for to basically be bearish of bonds. But we would rather see it happen rather than anticipating it. Certainly, if it breaks, it'll be a major risk-on event, probably impacting bonds far more than they will impact the whole of the equity market. The next chart I would like to show you today is XLK over XLI. XLK is technology, XLI is industrials. Now, Trump keeps on talking about jobs for industry, manufacturing, etc., 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 you would have thought that XLI would be doing extremely well against everything, and it's not doing badly. It's just that it's not doing extremely well against XLK. Well, you could say, wow, what is going on here? Basically, it's in a narrow range between 75 and call it 85. It is just trading up and down, and not much is going on. Well, that might be true until we do this. And the this I was referring to is change it from a daily to a weekly spread. It looks completely different, doesn't it? Basically, what it's telling us is that we are very, very close to the breakout from a 20-year consolidation in XLK against XLI. This could be an enormous, enormous move back towards the levels we last saw in 2000. If we get that, basically technology stocks will double and triple in price against the industrial stocks. It is a stunning chart to us because you hear all the time the press saying how the FANGs are overinflated, how technology is at ridiculous levels of valuation, and yet this chart tells us that maybe the technology rally is only just now getting started. That is a stunning revelation and something that we will be looking at very closely over the next few months. Certainly this chart tells us that we could be only at the beginning of a relative move in technology towards everything else. The next chart is SPY over IWM, so it's the bigger stocks over the smaller stocks. It is breaking out of the down channel it has been in for the whole of 2016 and could be seen as a bit of a risk-off move. We don't think it's so much a risk-off as it is people buying bigger cap stocks for safety because they are not so sure. So yes, in a way it is a risk-off, but in terms of valuations, we think that this is more reflective of what is happening in the technology sector rather than anything else. The Russell is very financials heavy, and it is not so technology laden. So we think that this, more than a risk-off move, is the fact that technology is outperforming or will continue to outperform financials especially. So we think that now that we are seeing these moves above this trend line and above the 200-day and the 50-day moving average, certainly being too long of small caps is not a good idea, and that has several other implications. And here are the implications and what we think is really going on. Boring chart, isn't it? It's just going sideways. It's a chart of emerging markets against SPY. So it is just going sideways, right? Yeah, it's going sideways until we do this. And this is the same chart going back to 2007. As you can see, we had the dump during the financial crisis. Then we had one more high when people fled US stocks and went to emerging markets, and then we had a relentless bear market which basically I would say, ended only at the beginning of this year. We have made a huge double bottom and we are now breaking higher. We have turned the moving averages, and all we need to do is break above these levels, these horizontal lines, to have a very large move, which consists of tens of percentage points to the upside in emerging markets relative to SPY. So what do we think is happening? We think that people are now fleeing the valuations of the US and buying the much lower valuations in emerging markets and in Europe. That seems to be a trend. Whether it is going to be enough to break these these lines in these horizontal lines, well, we don't know. We think it will. So we want definitely to be overweight in emerging markets over the US market. And certainly if you are investing for the long term, this does not look like a bad place to put a lot of money to work for an upside, a significant upside. The very fact that XLK is outperforming XLI in the States tells us that this is likely to work. If you think about what is the world, well, the world is driven by technology, and let's face it, there aren't many better technology companies in the world than the ones in the XLK. But it is manufactured wherever it is cheapest to manufacture that technology. And the products of that technology, and that certainly is not the US. It is the EEM space. So that is what seems to be happening to us. It is that EEM will now outperform the SPY, and the XLK will keep pace with the outperformance of EEM. So we are looking for longs in XLK and longs in EEM against SPY. And finally, the chart of SPY over FEU. This break over the past couple of weeks was maintained last week, and the moving averages are now beginning to cross over. To us, that means that we will have several more weeks of probably testing this moving average from the downside before we break back down towards the levels last seen in 2014. That to us is confirmation of the move out of the US industrial sectors into European and emerging market sectors. It is a move which certainly should produce an outperformance in double digits in terms of percentages for Europe, but especially the EEM. So that seems to be the super cycle, which is ending, the one in which people invested blindly in US stocks regardless of valuation, and now are much more prepared to invest in the sectors that have been out of favor since 2008, which are EEM and Europe. Now we come to our biases for next week. The 5 and 10-year note, still no change. We still think we go to the 0.382 retracement. We didn't close below these very significant levels, so we think the move in yields for next week is still favored to the downside. Bund and bubble, nothing is going on. We are not going to be short of them. We still think the yield curve flattens and the more negative numbers become less negative, so we are probably preferring bunds to bubbles, but we don't see much happening there. Nothing happening in the commodities, therefore what reflation? There is no pressure on these sectors that we can see. ES, we see very little going on. Would not be surprised to see a 3 to 4% range for the next several months. And NQ, the technology laden sector, is the trending one, and we like it because we like XLK. Russell 2000 is probably going to be the laggard, as we showed you in our spreads, but we don't think it breaks 1340, and only if it breaks 1333 we will be saying that all US stocks will be in some kind of a downtrend, a short-term downtrend. But we have identified our super cycle. The super cycle is out of expensive US stocks into cheaper EEM and EU stocks, everything apart from XLK. So if you're constructing a portfolio, you have to construct one which is long of XLK, EEM, and say FEU against the SPY. European equities still buy the dip market, especially against the US, and will be so for the next several months. EEM is now in trend against developed markets, and therefore any dips in EEM you should be looking to buy. And DX, we just can't see it doing very much for the foreseeable future. We think that there is a move out of dollars into these markets, and therefore we see DX staying relatively weak for the next few weeks. Thank you very much indeed, and have a lovely weekend.